Welcome back, everyone, to the Automotive Market Minute, in which may or may not take just over a minute. My name is Steven Georgella.
My name is Philip Trepetowski.
And I'm James Sivko.
The most action-packed automotive market minute in our history starts with what the hell is happening with this market sell-off, the consumer fear versus reality. What are the real reasons, and how is it going to impact your dealership? Our Fountain Forward and national dealership performance, will be going over that data. And then what's driving pickup sales, but specifically high horsepower? We're going to dig into that. Now, let's go ahead and look into what's happening with the market thus far. A lot of interesting stuff here. First and foremost, baggage. Is this like coming off of a bad relationship? Are we having an individual come to us that we're trying to start a relationship with, but there's a tremendous amount of baggage? That's what we've been talking about for months. We've been talking about the Trump administration taking over. We've been talking about some of the facts when it comes down to previous spending, in which Mr. James Sivko and Phil will be unpacking later on. But should we really be shocked in any way, shape, or form as to what's happening in the market thus far? Based on all the information that I can find, I'm not shocked whatsoever. The administration that's currently in place sort of has to go back to a foundation to be able to go forwards. And so we shouldn't be shocked the consumer is fearful. We shouldn't be shocked that there's instability whatsoever. This should be part of the process. We all should realize it's like absolute fear before you can really make change. And it's like, that is the point where we are currently at. That's my observation. I've got the gurus here with me as well. And when looking at, and again, I'm going to lean over here to James Sivko, a lot of the GDP growth over the last couple of years came from government spending. And as we're going to talk about with delinquencies, it looks like people that have good credit and have good finances are holding strong. And it looks like individuals, the evidence shows that individuals that were in a little bit of a tight spot are going to continue to be compressed. And that includes not just auto loans, but that includes their credit card debt and delinquencies and other things that they're signing up for. So we should not be surprised that it becomes more and more difficult to get the subprime buyer approved at your dealership. So with that said, James, I know you gave me a little bit of information about this sell-off. Is there anything else that you'd like to add in which you think would be beneficial to the viewer?
The U.S. economy is always growing about 85% of the time. We did have a recessionary scare at the beginning of last year, and we may have one approaching again. It looks like this administration maybe wants to pull a recession forward. So a lot of adjustments in terms of reducing government spending could kick off a slowdown. Maybe that's the plan, is let's pull the pain forward so that we can finish strong. So it's not surprising that it's starting to show up in some consumer measures, anything from sentiment to delinquencies.
Beautifully said, Mr. Sivko. So here's the visual. If you are a subprime buyer, 60 days, there it is. That's the lowest since they started measuring this. Now, I believe, if I'm not mistaken, when we get to 90 days, there's a little bit more normalcy at the 90-day mark. But again, it looks like it's going to continue to bleed on. What I want to restate previously is this. It looks as if you are already in a tight spot, the spot is becoming increasingly tight. And if you're in a good spot, if you look at delinquencies for prime buyers, that number is not going down. In general, it's basically flat. So if you are high financial literacy or a high enough income, then you most likely are going to be able to hang tough through all of this, if you will, meaning it looks like this administration is going to have to go backwards for a while from an optic standpoint to be able to actually move forward and make these changes that are going to have a very positive long-term effect. And we're just telling dealers, if your closing percentages on subprime were at 12%, meaning if you have people coming in, you have 100 leads, you're closing 12 of them, don't be shocked if it's 10. Don't be shocked if it's 9. Because you're not going to get bank support. You're probably not going to get manufacturer support, as Phil will touch on when it comes down to incentives. Let's look at the aggregate performance for the month of February. Leads, you can see, even though the month is 10% shorter, 28 days versus 31, approximately 10% shorter, you'll see that lead volume was actually up. You'll see the appointments were up. New sales were up. Used sales were up. One of the best Februaries, if not the best February in automotive history, based on most indicating factors. And so what I would say is this: did we say during the month of January that there was plenty of lead volume? If we think the consumer and their buying cycle is 60 days, was there enough lead volume to be able to follow up on it and close a lot of those deals in the month of January? Once the dust settled, the new administration's in, people that were more weary, they were paying off their holiday bills, whatever it may be. Was there enough there? Yes, there was enough there. Now, the 10th update, we do 10th, 20th, and 30th. That will be done here at Fountain Forward in the next 24 hours or so. So unfortunately for this recording, it will be missed, but we'll definitely be releasing some of that information here in the future. But what's important to note is, amidst some of the stuff and the turmoil that I'm mentioning, is this that resilient customer we keep talking about? Is it a degenerate customer? Is it a resilient customer? Doesn't really matter what the name is. The number says it all. And it says, oh, we're still going to keep on buying cars. And we'll talk more about inventory and such, and how much the factories or just used car supply is or is not going to support the buyer. But in general, looks like a February to remember.
We had a cold snap in February, so it's great. That may explain some of the weaker traffic. It was the second cold snap of the year. Usually people in the first cold snap of the year, consumers will stay in. If you get your second or third cold snap, they muscle up and get out there and do the commerce that they had been putting off.
Looking at sales specifically from a national level, you can see new retail sales on the left, used retail sales on the right. Couple just key points I wanted to go through here. New sales up 7% on a year-to-date basis as we look year over year. And if we extrapolate that then on the used side, used sales are up 8% on a year-to-date basis. But look at on the used side, we typically see an acceleration through these winter and spring months into the end of Q1, beginning of Q2. It's tax season. We typically see this, but now look at where the supply is at. We're starting to see this shift. New days supply is up 11% against last year. It's still down fairly considerably when we compare that to 2019. It's actually down about 19% compared to 2019 or pre-pandemic. But then as we look at the used side, we see used is the tightest that it ever has been to start out this year, at least since the pandemic. But we know that used inventory is even tighter than the pandemic. So we're seeing a very, very tight and constrained used inventory market right now.
Real quick on that, just interesting to visualize it, seeing the fact that the normal trend, as you said in slide 7, shows the retail sales on the used side. You'll see it on the right side of your screen. You'll see it continues to go up, and it's above 22, 23, 24. But then you go to slide 8 and you look at the right side of the screen here, you're going to see the fact that it's now below 2023, it's below 2024, and it's below 2022. So at what point do we smack into a wall?
If we take this back and we look at 22 and 23, clearly there were supply chain issues. So James, why is the used vehicle market so tight?
The used vehicle market is tight because of consumer retention. Pre-COVID, 3-year-old vehicles, consumers would get rid of about half of them, 52%. COVID strikes and everyone held on to their used cars. So now dealers have got kind of an empty 4-year-old bucket, a very empty 5-year-old bucket, and an absolutely empty 6-year-old bucket. But the retention trend continues, and only about 38% of consumers are expected to get rid of their cars in 2025. These stats are from our friends at Black Box. But 38 divided by 48 means that coming into the market in that vital 3-year best used car to sell, best used car to flip category, you're still going to see 20% less than you would normally expect to see. So continued tightness in the used car market, and 3 years aren't necessarily coming to the rescue at the rate we would like to have them. So stock the lots now in anticipation of this, and we should all prepare for higher used car prices, which, by the way, 2 and 3 years ago were features of some of these inflationary spurts that we saw in the broader economy, was just higher used car prices. We are going to see a reacceleration of used car prices in 2025. We've covered it on the Market Minute. We've talked about a lack of 3-year lease roll-offs. So some of the highest quality used cars are not going to be available. It's going to create a mad scramble for mid-grade and low-grade used cars. That's a big part of the CPI. And that has been a big reason why the CPI has fallen throughout 2024. So we'll see some inflationary headwinds in 2025.
I mean, I've never met Nostradamus, but you seem to look a lot like him at this moment.
I see a data point from Edmunds, 3-year-old used vehicles, prices up 3.3% year over year right now. We're seeing it.
Yeah, and why would I, as an individual that got into that car 3 years ago at X interest rate, why am I going to go and buy a newer vehicle that is more expensive now with a higher interest rate?
Yeah, so we've been waiting to dissect this part of the car market for a while now on the Market Minute. Pickup truck stats get hidden in light truck sales stats, which include all of those SUVs. But nationally, pickup trucks are about 1 in every 6 vehicles sold. And if you're in a Sunbelt rural dealership, that could be 1 out of every 4, and in some cases, 1 out of every 3 vehicles that moves across your lot. So what we've done here is we've multiplied some series together. This is car production of pickups. And if we go to the next slide, what we do is we multiply it by our seasonally adjusted annual rate across all cars and light trucks. And for the first time ever, we have an indicator of how many pickup trucks are sold in the US every single year. This year, we've had a particularly strong year, 2024 over here on the right. Still trying to get those last December numbers into the Commerce Department, but about 2.3 million pickup trucks were sold. This is cyclical, and it depends. It's very closely tied to one stat, and that is, in the next slide, construction spending. This is residential construction spending as a percentage of GDP on the right, and this is our pickup truck sales on the left. And so there's a very close correlation here. The little bit of an air pocket that we've seen in the last few months in terms of residential construction spending is going to get made up for industrial construction spending in the US and spending on building brand new factories in the US as well. Those are some economic series that are going gangbusters, but basically your pickup truck buyer builds things. What business are we in here? What do consumers in general respond to? And when we see an economic series that goes in one direction for decades, this is a 40-year trend here in pickup trucks. If it goes in one direction for 4 decades, then that's what sells the item. And so what business are you in sometimes as a car salesperson? You're a fund merchant. Horsepower is up in every single category, whether it's SUVs, cars, but the one that it's gone up the most in, and the one that it's jumped the most in, is pickup trucks. And so as you're going down the list, and it's a coin flip between a couple of models where you are trying to fill that last space or two as you are re-merchandising and refilling the lot with pickup trucks, the tiebreaker needs to be horsepower. Consumers are responding to horsepower. Yes, we know it needs to be some combination of torque and displacement and horsepower and all that stuff. And so does the consumer who's buying the thing. But in the end, the one stat that they're interested in is how many horses are under the hood.
Wonderful information here from Mr. James Sivko, especially looking at the fact that as you can get a little bit more picky and choosy when it comes down to choosing your inventory at the factory level, it's pretty simple. I'll take a little more horsepower and try to keep the overall MSRP down as low as possible. It's almost like strip out some of the other stuff and just make sure that you have a bunch of horsepower and you'll have some leverage with the consumer. A couple other things from an actionable standpoint that I want to focus on here. We've talked a lot about the fear and the position of the subprime buyer. I want to go over a couple of key things as takeaways for dealers here. Number one, the 3 reasons why it's so difficult to finance a car. It's poor or no credit history, high debt to income ratio or insufficient income, or employment instability. As dealers, we have to make sure that we're looking at the individual and looking at their pain points and making them the hero. If we make them the hero, we will get the opportunity to earn their business. If we're not making them the hero and we're looking at how business was done before, we're going to struggle. So as we see these delinquencies rise, we have to again go back to the core issue and why they're having a hard time. And if we focus on those 3 things that I mentioned, we will be able to earn their business. We will be able to take down the dealer down the road, take more market share from them. So it's definitely a big takeaway from this month's Automotive Market Minute among the many takeaways from Mr. Phil and Mr. James. This is action-packed. We don't get great content unless there's a little bit of turmoil in the market. Everybody can feel good winning. Winning creates complacency. We need some shifts, a little bit down to be able to rebuild and have this amazing future, this stronger future. And this month's Automotive Market Minute revealed just where the market's actually at and some of the things that might happen here in the future. And I'm stoked on behalf of my beautiful colleagues, Mr. James Sivko and Mr. Phil Chebotowski. My name is Steven Georgella. Thank you. It's an honor to have another Automotive Market Minute. And God willing, we will have another one next month. See ya.